ETFs were going to be weapons of financial mass destruction.
My whole career
so
they have been, yeah.
right, exactly. And so in my mind, this is like really a repeat of those conversations. The mechanics are not exactly the same, but they really rhyme a lot. You can look the blockchain to see where the balances are in each one of these Bitcoin ETFs. A regulated, registered vehicle is just about the worst place that someone should try to launder money. It has been a common concern in Bitcoin and crypto over the years, but I think it's been overblown. One of the things that's so amazing about the Bitcoin blockchain is just how transparent it is. What I think is going to happen in the next 5 years is the ETFs are going back on chain. And so the ETF itself, just like I think all stocks, bonds, securities, and assets are going to get tokenized, I think that the ETFs themselves are going to get re-tokenized.
All right, folks, welcome back to Rabbit Cave. My name is Dave Nadig, President and Director of Research at ETF.com. And today, very excited to be joined by Teddy Fusaro, who's head of trading capital markets. Teddy, what's your actual title over at Bitwise?
I am the president of Bitwise Asset Management. And in my capacity, I also want to say to you, Dave, since I have the honor of being here with you on the first week after the announcement, congratulations to you on your new role as president of ETF.com.
We can be co-presidents here as we figure this stuff out.
That's right.
But I'm not wrong that you are heavily involved in the deep weeds of how this thing trades, how all of these crypto ETFs trade now that they're alive, right? That's your core.
That's totally right. And, like a little bit of background, before I got into crypto full time at the beginning of 2018, end of 2017, that's how I grew up. I grew up as portfolio manager, head of trading, head of ETF capital markets, head of operations at a handful of early stage and alternative types of ETF issuers. So just at around the same time that you and Bitwise CIO Matt Hogan were running around and standing up the first big ETF publication companies, media and research companies, I was on the other side doing all of this stuff with market makers, with APs, with structuring. And I feel like, in my mind at least, it wasn't all that long ago that the same types of things that we're going to talk about today related to Bitcoin and crypto ETFs were the hot topic for equity ETFs and fixed income ETFs. How does this stuff work? Oh my gosh, is there risk here? I remember, ETFs were going to be weapons of financial mass destruction.
My whole career
so,
they have been, yeah.
Right, exactly. And so in my mind, this is like really a repeat of those conversations. The mechanics are not exactly the same, but they really rhyme a lot. And so, yeah, that's what I grew up doing. That's what I still oversee the portfolio management, trade and capital markets and product structuring teams here at Bitwise. And this is the stuff I love talking about, and nobody's better at talking about it so that others can digest it than you, Dave, and happy to be here to chop it up.
Awesome. Well, let's dig in. So let's go back a little bit. It was January last year. We got the first of these things trading at all. And back then, I sort of approached them as, well, they're just like bond ETFs, because back then, or still to this day, a lot of bond ETFs, if you show up to, with $1 billion to get into AGG, chances are you're actually going to be giving them mostly cash. And particularly some firms like PIMCO notoriously don't want in-kind creation. So if you want new shares, you're giving them cash, they do the trading. If you want to get out, they do some selling, they give you the cash and you're out. That's how things have been working, right? What's different about how it had been working versus that sort of base case for bonds?
Yep. So maybe we take a little brief detour down memory lane and we go back to the time that the Bitcoin ETFs were initially approved, as you said, January 2024. So as we're in the run up to that approval process, one thing that was sort of the source of a bit of consternation in the industry is all of the issuers were going to the SEC and all of them wanted to do in-kind transactions. And all of them, if you're really deep in the weeds, all of them up until really the last sort of couple of days or weeks had the ability to do in-kind creations and redemptions in their regulatory documents, in their prospectuses, in their filings. At the time, kind of in the final mile, the SEC had said to them, we're going to allow these things to go to market, but we're not going to allow you to do in-kind creations and redemptions. And here's why. The why is that in 2020, so you're going to go all the way back to 2020, the SEC had issued a release. Maybe we can put this in the show notes. It's release number 34907888. And this release, I'm telling you, I've been through the ringer on this. This release has to do with custody of digital assets by broker dealers, special purpose broker dealers. And what they had said in that release is that you could be a special purpose broker dealer and you could take custody of either digital assets that are securities or other digital assets, or you can be a regular broker dealer, not a special purpose broker dealer that has custody of regular securities, but you can't do both.
Right.
Can't have both Bitcoin and what we call in crypto TradFi securities. Right. And that was the loop that they couldn't close in this process. They still had this guidance outstanding. And they had to approve these ETFs basically because of the Grayscale lawsuit. But they wouldn't do it with in-kind creations and redemptions. And so the way that these things came to market in January of 2024 and the way that they have been operating up until this month has been cash only creations and redemptions. And so that's just kind of setting the stage.
Got it. And let's talk about what that looks like, because I'm sure in some of the other products and certainly in other crypto securities, not everything is going to be in kind out of the gate. So talk a little bit about that process. A normal authorized participant, and for folks who aren't familiar, that's generally a big market maker, a Goldman, a Bank of New York, somebody like that, a GTS, a big one. They show up and they're the ones that actually deliver a bunch of cash to you all. And what they're expecting back is BitB, right? That's what they're hoping to get back after the end of that transaction. So that comes in like a normal creation, right? Sometime in the afternoon, you get the notification somebody wants 50K shares or something, and then you end up with a bunch of cash. Can you walk through the process of that? If I'm showing up at 3 o'clock with a creation order for cash, how quickly does that turn into a transaction, and who's making that transaction?
Yeah, absolutely. And before I get into it, I'll also just say that something that I don't think was broadly anticipated is that this actually ended up working out better for most of those APs that you referenced, because most of the APs are big TradFi institutions, like you said, and didn't yet at the time have Bitcoin trading, Bitcoin custody, Bitcoin transacting.
So this was actually a bit of a get out of jail free card for a while.
Yeah, like it got a little like, and I remember saying this to our counterparties and to the market and to the SEC at the time, like, do you think those companies that you mentioned are ready to turn around and deliver Bitcoin to us? Remember, this is a different era. I know everybody's working on it now, but in December 2023, in January 2024, not all of these banks were standing up crypto trading desks.
For sure.
So this worked out better for them in the short run. Now, to go more to the heart of your question about how it works, yeah. So you have every single day that the stock market is open, the ETF is also open to take these creation units, large blocks of shares that one of these APs, a registered broker dealer who has one of these authorized participant AP agreements with the ETF, can come in and they can enter an order. It has to go through another TradFi institution, usually Bank of New York or State Street, the custodian bank, to say, hey, I want to create 50,000 shares of the ETF today. They put that order in. Now, instead of the kind of regular way process that we all know in ETF land, where they're going to give us the underlying assets to settle the trade, they're not going to do that. They're going to deliver us cash. And so when an AP comes into our ETF today and says, I want to create 50,000 shares of the ETF, my portfolio managers know that they need to spend that cash today to buy Bitcoin. And so what do? They go out to the market. And here, when I'm referring to the market, I'm talking about what we refer to as OTC trading desks. In our regulatory filings and our disclosure documents like our S1 or our prospectus, we refer to these as Bitcoin trading counterparties.
Got it.
Think about firms like Cumberland, FalconX, B2C2, Nonco, Flow Traders, Jane Street. These are the largest Bitcoin trading desks in the marketplace. And so what our team does, our portfolio management team does is, let's say the 50,000 share create is worth $10 million. They go out to this roster of liquidity providers, trading counterparties, and they say, hey, I need to trade $10 million worth of Bitcoin today. And those counterparties are going to provide a quote back to our desk that is relative to a pricing benchmark. Most of the ETFs use a pricing benchmark that is from CF Benchmarks, which is effectively a 1 hour time-weighted average price between 3 and 4 p.m.
So that's BRRNY, right? That's
BRRNY.
Got it.
On
Okay.
Bloomberg. Yeah, exactly right. You can find it on the CF
And that's
Benchmark
basically
website.
just telling you going into the close, which the Bitcoin isn't closing, obviously, but going into the close of the ETF trading, 3 to 4, and that tends to be when most of the AP orders have rolled in by then. That's when you know I got 10 million to buy, and you're going out to one of these counterparties and you're saying, what's the best you can do for me here? And they're going to say BRNY, plus or minus something, depending on which way it's going.
Exactly right. So they're gonna quote you, okay, plus 2 basis points if you're a buyer, minus 3 basis points if you're a seller. We're a buyer today. One of them comes back with +4, the other one comes back with +3, and the third comes back with +2. We're going to hit the +2, or we're going to lift the +2 offer, and we're going to be buying Bitcoin on that day for BRRNY, which hasn't been published yet, right? It's the 3 to 4 pricing window. And we're going to buy that Bitcoin for 2 basis points above whatever the benchmark price is.
Got it.
Then, right, so that's on trade date. Today is the day that the order came in and the day that we traded. And then tomorrow, settlement's going to occur. So tomorrow,
let me tease that apart. The settlement in the Bitcoin that you're buying pretty much happens a couple blocks later, right?
So the settlement occurs on T1 for all legs of the transaction.
Okay.
The important thing that we drove forward at Bitwise that was very important to us is none of the first piece of the settlement has to be that Bitcoin arriving on chain at our Bitcoin custodian. And we can talk a little bit more about that if you want, but from a risk perspective, for the sanctity of the product, we don't want to be sending cash out and we don't want to be sending shares out until that Bitcoin has settled on chain at our custodian. So tomorrow, the first thing that is going to happen that kicks off the settlement process is we're going to be waiting for that $10 million worth of Bitcoin that we just purchased at BRRNY +2. We're waiting for that to settle on chain at our custodian. Once that hits, we're willing to send the cash to the trading counterparty and send the shares out to the AP. And that's how the settlement process unfolds.
And does it still work sort of through the overnight matching process at NSCC like most creation redemption does, or is there a sidecar process here?
The equity leg works that way.
Okay.
So the settlement of cash versus shares works really synchronously with the existing TradFi pipes.
Got it. So we're going to come back to some of the custody issues here in a minute, but let's just stick on this money coming in thing. As of a couple of weeks ago, that's different, right? So now you guys have done the first, and I'm going to guess there've been some more in-kind creations. I don't know whether there've been any in-kind redemptions yet. Talk to me about what's different about that, because now instead of showing up with cash and then sort of doing a buy and waiting for the Bitcoin to actually show up, now you're actually just getting like, hey, here are the coins, just like a wallet transaction like anybody else would have, right?
It's totally right. So really, like, the way that I think about it simply, and then we'll go into the weeds, as I know you like to do, and I like to do that too, is it just compresses down the complexity. So all the stuff that I described to you about going to 3 counterparties, asking them for a quote, considering which one is the best quote, lifting the best offer or hitting the best bid, waiting for settlement tomorrow, needing to wait to send the cash. None of that needs to happen. And importantly, that 2 basis points of slippage, that 2 basis points of trading cost that we paid above BRRNY, that doesn't need to happen either. Here's why. If the order is in kind, all we're doing is accepting the order. We don't need to go out and trade today. We just wait until tomorrow. And then tomorrow, we just wait until the Bitcoin arrives. We don't have to pay for it. Once the Bitcoin arrives, we can turn around and send out the shares to the AP that created it.
Got it.
And so it's, you've gone from needing every element of the cash transaction to just stripping that out, taking it away, and all you're doing is waiting for Bitcoin to be delivered, or in the case of redemption, delivering out Bitcoin. And that's all you need to do. And where I say the efficiency comes in is because going back to our transaction of my portfolio managers spending the money to buy the coin, remember the example I used was that we paid BRRNY plus 2 basis points. Someone's got to pay for that 2 basis points, right? That's got to work its way into the spread. It's got to work its way into either a slight premium or slight discount to fair value, depending on how wide that bid-ask spread is on actually buying or selling the coin. And that piece of it goes away. And that's why we think that this really collapses the cost structure for this, because of that efficiency in the in-kind process.
Does it change the nature of the kinds of APs you're dealing with? Does it change that list? Like, are there only a handful of them that can do the in-kind, but you still got some that are showing up with cash?
Dave, you always go right to the important question. And there's a reason that I had started with the SEC release number that we're going to put in the show notes, because the like a complicating factor here is that while this past month the SEC did approve the ability for in-kind creations and redemptions to occur, they have not yet closed the loop on the broker-dealer custody release. Meaning, they said, okay, ETFs, you guys can go ahead and accept in-kind creations and redemptions. They did not say, we are rescinding SEC release number 3490788 and issuing new guidance for broker-dealers. So that still needs to be a loop that is closed. Now, by all indications, all the regulatory process and movement that we're seeing, we're anticipating that will get closed. But for now, all of these APs, which are also broker-dealers, in order to be an AP, you need to be a broker-dealer. They all need to figure out how to comply with this complexity on their side. It's not an ETF
so you can only
issue
work
per
with
se.
you can only deal with the crypto native people at the moment for those kinds of in-kind creates, because they had to have made that choice about which kind of BD they want to be when they grow up.
So there's a few different models that can work here. One that we have seen work the best is, over time, a lot of the ETF and crypto market makers in general tend to be the same types of firms, because if you're good at making pipe bids and offers in the futures market or the ETF market or the equity market, that technology ports over really well to being good at keeping tight markets in the Bitcoin market, right? And they love the Bitcoin market. It's 24/7. It's global. It's liquid. It's volatile, right? Like it checks all the boxes.
Trader candy, I get it. Yeah,
it's great. So what has happened over time is that a lot of these global trading firms have set up different entities than their US domestic registered regulated broker dealer that can handle their crypto trading. Now, some of the firms that you mentioned haven't gotten to that step yet, but others that you mentioned have, and have had this infrastructure operating for a few years. So really, it's a scenario where the ones that are now ahead of the game and have been in the market from a regulatory perspective to trade Bitcoin spot or crypto spot, they can facilitate these types of transactions. There's another path where, if you are a registered broker dealer that doesn't have a crypto trading entity, you can effectively appoint an agent to do the delivery for you.
Right. Yeah.
Yeah. So there's a few different models, but what I would say is that, like, this is still system wide. this is still new and the market is still adjusting to it. We see a lot of demand for it. We can talk about some of the reasons for that, but the market is definitely still adjusting.
Got it. Okay, let me dig in a little bit deeper on some of this. One of the issues that I had read was a concern about doing sort of in-kind creates, people just showing up with a whole bunch of their coin, was that, some coins are good and some coins are bad. They're addresses that are, excised and not on white lists. And there are attempts in the AML KYC process to keep people from using things like a creation redemption process to sort of magically blend their bad actor crypto. How is that resolved now? Because that was an issue, but apparently it's not anymore. Did the broker dealer community just sort of figure their side of that out, or did you have to do anything?
Yeah, stepping back from that, I would first say it was a concern that was often raised, but in the first instance, a regulated registered vehicle is just about the worst place that someone should try to launder money. It's just
I
not a good
agree.
idea. It's not going to work well for someone who's trying to do it that way. Um, and it has been a common concern in Bitcoin and crypto over the years, but I think it's been overblown. One of the things that's so amazing about the Bitcoin blockchain is just how transparent it is, right? But how you deal with that as a practical matter is that an ETF entity or a regulated entity is going to accept a delivery of Bitcoin from needs to have KYC and AML procedures done over that relationship. You exchange test information with the wallets and you do off chain. We prefer off chain, on chain, off chain KYC AML on the entity itself that's going to do the delivery. And so like that's the basic practice for how you know that everything is going to be safe and sane. But the other thing I'll say is that we work with, and all the Bitcoin ETFs do, work with regulated institutional Bitcoin custodians. And they have very high standards for this too, as you can imagine. And they do things like run tests and ongoing scans on all of their incoming transactions. So even away from what the ETF is doing, the custodian is looking at all the incoming deposits to see what's happening here. Where has that coin been? Has it been in any quote unquote tainted wallets or tainted locations that are known to be
Got it.
affiliated with any kind of nefarious activity? So it really, to me, once you start digging into how one would even consider doing something like layering or using one of these funds as a money laundering tool, it seems like a really bad idea. Because then remember also, like, what you're getting back is U.S. registered securities.
Right.
So like, what's the point? What's the point of sending bad Bitcoin into an ETF when you're getting back registered securities? That have to be traded and custodied in a regulated institution.
That makes sense. So it sounds like there's at least the two different gates. There's the gates that are set up in the relationship that the ETF has with the broker dealer community and that whole process, where there's one layer of check. And then in the back, you've got Coinbase custody or somebody else putting their own layer of checks on everything that comes in the door. So that makes total sense. Let's talk a little bit more about that custody relationship. One of the myths I wanted to try to bust here, which I see every time I bother to wade into a terrible Twitter thread about people thinking the world's ending, is that this is all paper Bitcoin. And how do you know anything is that? It's the same thing we got with GLD. There's no gold in the vault. It seems like exactly the same argument we've had forever. And for exactly the same reasons that I think GLD got heat on this, which is there's a difference between where all the money really is and the little sliver that you need to keep alive to trade and like have some cash to pay for things here and there. Can you talk a little bit about how that works, maybe differentially versus something like GLD? There's still the same concept of the sort of stable, secure pool that's really hard to touch and the little bit that's actually getting traded every day, right?
Yeah. Well, for us, I'll say for Bitwise, the difference in custody is that Bitwise keeps every Bitcoin, all of the Bitcoin in the cold storage solution at the custodian. It doesn't touch an exchange. It doesn't go through a hot wallet. It's all straight into cold, straight out of cold. And so that's one thing. But the other thing is really, even compared to GLD, And we know that that's fear mongering and conspiracy theories. We've been through those. But even compared to that, Bitcoin is amazing because it is so transparent. You can look the blockchain to see where the balances are in each one of these Bitcoin ETFs, even if they don't publish their addresses themselves. There are block explorer tools that you can use to see what their balances are on chain. One of the reasons that Bitwise, I think, was very successful in the early going is because what we did was we actually published on our website all of our Bitcoin addresses, so people could go and check those themselves. It since became very difficult to follow them all because we had so many different addresses that we actually even recently upgraded to a new service that does a proof of reserves, and we publish that on our website now. Not all of the issuers do that. I think that they all should. We encourage all of them to do that, and I think they should. Um, but yeah, the transparency of the blockchain, of the Bitcoin blockchain, really makes this even more of something that investors can get comfort in when they're looking at an ETF. And then the other thing I would say is, and I'll come back to this as we talk about why some of the largest and most prominent Bitcoin investors over time are starting to switch into ETF holdings, which is an amazing development that I didn't anticipate. That's happening now. One of the reasons for that is because you get such strong comfort with the custody process that the ETFs have. Now, look, these are bearer instruments. Bitcoin is a bearer instrument. You can never completely rid yourself of the custody risk. But in an
Just like
ETF,
gold. Somebody can
just like
theoretically
gold,
break into the JP Morgan
yeah,
vault and walk out with a 400-ounce gold bar.
it's a risk. You need to disclose that risk. You need to comfortably talk about that risk. It exists. But at least with the ETFs, you can be sure that your ETF sponsor is an important client of a state-of-the-art custodian that is providing custody over those assets in the best way possible.
What's your take on some of the criticisms around custody that, well, you should have 5 different custodians to diversify your custodial risk. People do that in gold, like that. Some of the gold ETFs make a big deal about the fact that they have gold in 16 different vaults. Like, is that a real issue? Is there really even a service industry where you could say we're going to be in 10 different custodians?
This is one that I think is a thoughtful criticism or a thoughtful risk. I don't know what the right answer is. Certainly we have chosen, and we work with Coinbase Custody. Coinbase Custody Trust Company LLC. It's a fiduciary under New York State banking law. They hold themselves out as a qualified custodian. They are regulated by the New York Department of Financial Services. They have SOC 1 Type 2 and SOC 2 Type 2 audits. Those are all things that give us a really high level of comfort with their service. They're also a legally separate entity from the exchange,
Right.
which I think is really important. It's not the same as having your money at an exchange. It's a legally separate custodial entity. They have an impeccable track record. But when people say, wow, the big players, Bitwise, iShares, they have all of their assets with the same custodian. Is that creating a centralized risk? It's that I am thoughtful about. I do think that the way that this resolves over the very long term is that there are multiple custodians for each ETF. But I would also say that, like, what's the other side of that, Dave? It's like you it, you're diversifying your risk perhaps, but you're also creating more surface area for risk.
Oh yeah, sure.
If you it's not acceptable to lose 1/5 of the Bitcoin, just like it's not acceptable to lose all of the Bitcoin. It's not
No,
acceptable to lose
I
any
get
of the
that. I
Bitcoin.
get that. But it does seem like SAB 121, right? The accounting rule that got revoked. That
Yes.
allows people like BNY to get into this game now, where before sort of Coinbase had a bit of a monopoly because they weren't doing the other stuff and they weren't allowed to. Do you expect that over the next couple of years we're just going to have like literally everybody who custodies anything is also going to custody crypto?
All of the big custodians will provide crypto custody services. There's no question about that in my mind. But there is a question about how much market share do they take, and do
Right.
they buy or do they build, right? Because like I said, the track record of Coinbase, of Anchorage, of Fidelity, these are really the three of the largest crypto custodians that we have. It's impeccable. They've spent the better part of a decade developing these solutions, hardening them, building them such that they're the best in the world. It's a pretty difficult thing to play come from behind with that tech stack and that moat that has been created by developing that business and that technology over the years, right? What we're talking about when we talk about crypto custody is we're talking about generating a private key, storing that private key, and then using that private key to sign transactions, right? And getting the years of reps, building a process that can withstand these service and organizational control audits that I talked about. These are things, getting these audits done from a Big Four auditor takes years to get done. You can't just get one in a couple of months. You're talking about needing to have auditors embed physically into the process to ensure that the internal controls and systems over financial reporting or related to security are operating effectively. And so like the SAB 121 thing was bad for the industry generally because it didn't allow the big players to come in when they should have been allowed to. But it was also like a great moat for the early crypto custody companies because they got to get this multi-year advantage in building these systems and building these processes.
Right. All right. Couple more myths I want to bust here before I let you go. I got into a little bit of a discussion with Tom Lee on CNBC about a month ago where he was convinced that what was going on in the Bitcoin ETFs was a whole lot of tax washing. That's a whole lot of hooey, right? There is no tax advantage for this in-kind creation redemption in the Bitcoin ETFs, is there? My understanding was this was basically just like owning Bitcoin, like a pass-through.
It is a pass-through, but maybe this is a good point in the conversation to talk a little bit about why the in-kinds coming online are opening up a lot of new investor possibilities, and a lot of big Bitcoin spot investors are thinking about moving into the ETF. So under the tax law generally, just like for in-kind transactions in an equity ETF, if I exchange like for like, I don't have a taxable event when that transaction occurs, right? So if I give you the stocks in the S&P 500 and you give me an ETF back that represents those 500 stocks, I don't have a taxable gain on my transfer out of those underlying stocks. The same thing applies in theory to Bitcoin, right? So if I have Bitcoin that I purchased in 2015 that has now grown a lot, and I'm storing it on a ledger device, ledger over here, fresh ledger. If I'm storing it on a ledger device, I maybe have seen the value of that Bitcoin grow 10-fold or 15-fold. It's outside of the financial system, right? But if I can find a way to give my Bitcoin to someone and they can give me shares of the ETF back, then I may be able to get out of that spot position and into an ETF without recognizing a taxable event. Now, it's a little more complicated than that because, of course, if I'm just sitting here at home with my Bitcoin on my ledger device, I'm not an AP. I can't do that directly. We talked about KYC and AML concerns. But if you can find a way to do it, there's a lot of reasons that early and large and other large Bitcoin investors are considering doing this. It's outsourcing the custody risk to a registered, transparent, listed security that has an auditor that's doing this on-chain analysis to make sure that their assets are there with their custodian that's getting their financial statements audited every year, that has a big relationship with the custodian. Even if I have $100 million worth of Bitcoin, I'm not a big client to the biggest custodians.
Right.
But the ETFs are all big clients to the biggest custodians. So I can then outsource that custody risk. I can do it tax efficiently. I also, if I want to give some donations to my favorite charities, it's pretty difficult for
Give
me
the
to
BTC.
give
Yeah.
Bitcoin, right? Some of them might take it, but everybody accepts all charities typically
So
accept
yeah, so
securities.
I get that there's a convenience layer. Like once you're on the TradFi rails by owning BitB versus owning BTC directly, now
Yep,
I can send it. I can present it as collateral some places. I can
collateral.
sell it in small blocks here and there. Like I can margin against it. I understand like there's real value in having that investment now sitting on the TradFi rails, but there's not like
Yep,
a magic tax dodge here, right? It's not like you just get
not a
out of your
dodge.
98% gains that you've been holding on to.
No, because you can't erase the unrealized gain, right?
That's right.
You have to carry it over. You're gonna have to pay taxes on it eventually. But
Okay.
you you can get it into the system. Another big reason is estate planning, right? Like, okay, my wife may not know how to access my Ledger device, but if it's in my Fidelity account or my JP Morgan or my Goldman
Right.
account,
Just goes through the
then that
trust
can be
accounting. Yeah. Yeah.
exactly,
The step of it
exactly,
is
right?
just the whole nine
Yeah.
yards. Yeah. Yeah. Yeah.
hmm
I totally
hmm
get that. I totally get that. Okay. So I just wanted to make sure because that is another thing that I hear people saying is that everybody's loading into the Bitcoin ETFs because they get a magic tax dodge, which just I've never been able to figure out why people think that. And
No,
the other big tax efficiency we get with ETFs is kind of irrelevant because you aren't making capital gains distributions out of a single asset fund, right?
that's right. Yeah, and there is no tax dodge. We get that question too. It's like, again, not the place for it, and it's not going to happen. And whether or not people are paying all the taxes that they owe on their own personal crypto holding, different question. But just like the money laundering thing, not the place to do it in a regulated wrapper that
Right.
has to settle through a broker dealer.
All right, let's close up with one thing. So this has been a big deal from the like from my perspective, it feels like an actual bridge, right? We're going directly from the crypto rails directly to the TradFi rails and skipping a whole cash step in between. So feels very much like we're finally getting the promise of ETFs as the bridge product between the two ecosystems. But that's just BTC right now. How do we think about how this is going to impact something like the Bitwise 10 or other potential future index products or actively managed products where you've got multiple coins trading against each other, and then you may actually have capital gains that need to be washed out or distributed? How do you think about the impact of this on portfolio management for the funds that you guys run that are really portfolios, not single assets?
Yeah, so I have maybe obvious answer, and then I have another a little bit zanier answer for you, Dave. One, it's going to take a little bit of time, but I think it's going to happen for all the assets and all the portfolio strategies. So Ethereum, Solana, XRP, down the chain, I think they're all going to be operating in this world eventually, where we have in kind out index products. I think it's going to happen there too. And I think the same tax efficiencies that you get in the traditional world with custom redemptions and creations and the ability to move things in and out through the in-kind process without recognizing taxable events at the portfolio level, I think those are going to happen too. But the crazier thing that I want to say is, in a sense, right? What we've done with Bitcoin ETFs is we've taken the on-chain asset and then we've moved it off chain so that all the normal people who want to manage their wealth and their financial lives through their brokerage account can access it. What I think is going to happen in the next 5 years is the ETFs are going back on chain. And so the ETF itself, just like I think all stocks, bonds, securities, and assets are going to get tokenized, I think that the ETFs themselves are going to get re-tokenized and put back on chain. And then as we're doing everything else on chain in the future, ETFs are going to be still first packaged in the traditional security wrapper, traded as they are, but there's nothing to stop anyone once we figure out how tokenization works at scale to re-tokenize the untokenized version of Bitcoin
Yeah.
and put it
Okay.
back on the blockchain.
All right, you're right. That is crazy. Uh, I'm a seller on that only because I don't want it to be true, not because I don't think we should tokenize assets, but because I want us to actually tokenize the assets, not wrap everything in another layer, because that just adds complexity and risk. But that is a story for a whole nother day.
We're coming back to talk about this soon, Dave. And in 2030, when this has all happened, I'm going to be the one here who's saying I told you so.
No, I think I think you're right. It is going to happen. I'm just sad about it because what I actually want is Congress to write real laws that change the infrastructure so that DTC is tokenized, not that we're wrapping a bunch of crap in another layer. So, but I can dream about that. Teddy, this has been a lot of fun. I will get you back on to talk about real world assets and tokenization. I promise. Thank you for joining us. Anything, where can people find information about what you guys are doing? What's the best way to find you?
BitwiseInvestments.com, and I'm on Twitter at Teddy Fuse.
All right. Thanks so much, Teddy. Cheers.
Great to be with you.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.